Hello, and welcome to this explainer. I'm the chief financial educator here at NitiVitt. Today, we're going to deconstruct a surprisingly common myth. It's this idea that successful financial planning is simply about, finding a way to earn a higher salary. But actually, it really isn't. Achieving true financial independence is about following the correct mathematical roadmap. We're going to look at why building your wealth absolutely must follow a very specific sequence, and how doing the right things in the completely wrong order creates massive financial stress.
Okay, let's dive into this with a little scenario. Imagine two people. Let's call them Person A and Person B. They both start their careers at the exact same time, in the exact same city, earning the exact same salary for 10 straight years. Yet a decade later, Person A is financially independent, they're relaxed, and they're building assets. Person B, on the other hand, is trapped in EMIs, stressed out, and living paycheck to paycheck. So what happened? The difference between them isn't their income. It's the order in which they made their financial decisions.
Think of personal finance exactly like building a house. You would never dream of installing expensive glass windows before you've laid a solid concrete foundation, right? Yet millions of people do exactly this with their money. They chase aggressive investments, the windows, so to speak, before building a buffer to really protect themselves from life's unexpected storms.
To fix this, we follow a clear 6-step sequence. Step 1, protect yourself. Step 2, build stability. Step 3, eliminate bad debt. Step 4, start investing. Step 5, plan for life goals. And finally, Step 6, build retirement freedom. Let's start right at the beginning. Step 1, protect yourself. Building the financial foundation.
This foundation is the absolute bedrock of your wealth. Why? Because a single medical emergency can literally force you to liquidate everything you've built if you aren't prepared. The requirements here are pretty simple. You need independent health insurance, term life insurance if you have dependents, and an emergency plan. And here's a critical note, especially for young professionals. Relying purely on your employer's health insurance is a dangerous illusion. If you transition jobs or face a layoff, you could be left entirely uninsured right in the middle of a crisis.
And when it comes to term insurance, we don't guess. Mathematics decides. The deterministic rule to follow is an income replacement multiplier of 15 to 20 times your annual income. Being underinsured leaves your family vulnerable to total financial ruin. Oh, and if you have a home loan or other liabilities, make sure to factor those in so your debt never becomes your family's burden.
Moving on to Step 2, build stability. Creating resilience and positive cash flow.
So, once you're protected against those catastrophic risks, you need to build day-to-day stability. The crucial metric here is your survival number. For salaried individuals, the mathematical baseline is 6 months of purely essential expenses, so rent, groceries, and utilities. Now, this money must be liquid. Real estate and your Employee Provident Fund, or EPF, do not count as emergency funds. Why? Because you simply cannot liquidate them in 24 hours.
Once that 6-month buffer is sitting safely in a liquid account, we look at your savings rate. This single metric, which is just your monthly savings divided by your total monthly income, indicates your true capacity to build future wealth. You want to aim for a sustainable 30% or more. Notice I said sustainable. Extreme frugality almost always leads to financial burnout. Your savings should be a consistent surplus, not forced deprivation. All right, Step 3, eliminate bad debt, stopping the silent wealth killer.
Before you even think about growing your wealth in the market, you absolutely must stop the active destruction of it. There is a massive difference between EMIs that help you and EMIs that harm you. Good debt is asset-backed, like a home loan, which actually builds equity over time. Bad debt is high-interest consumption debt, think credit cards and personal loans. This toxic debt compounds so much faster than any investment can grow. If you have it, you need to clear it out.
To keep your cash flow healthy across your entire lifetime, follow the 20% debt-to-income or DTI rule. Basically, cap your total monthly EMI burden below 20% of your income. Over-leveraging your salary destroys your monthly cash flow, creates immense psychological stress, and completely halts your ability to invest consistently. Now for the fun part. Step 4. Start investing. Compounding, consistency, and long-term growth. Only now, after your foundation is secure and that toxic debt is gone, is it mathematically correct to start investing. By waiting until this step, you ensure you won't be forced to interrupt your compound interest to pay for an emergency. And remember this, habits matter significantly more than finding the perfect product. Don't let yourself be paralyzed searching for the ideal mutual fund. Just automate your investments. Consistency really is the best anti-aging routine for your money.
You also need a structurally resilient portfolio. Now, Here in India, there is a massive tendency to overconcentrate wealth in physical assets, specifically things like physical gold and real estate. But true financial maturity means spreading your capital intelligently across equity, debt, and liquid assets to prevent dangerous overexposure to any single market shock.
Which brings us to step 5. Plan for life goals. Juggling priorities before you spend. The average family faces immense, simultaneous financial pressure, right? You're saving for a house, funding a child's education, or paying for a marriage all at the same time. To juggle this successfully, you cannot rely on today's prices. You have to use future value math. For instance, the cost of higher education in India rises much faster than the general inflation rate. By using math to adjust for these life events, you set realistic targets and avoid being caught totally off guard.
And finally, step 6. Build retirement freedom. Independence is a number, not an age.
We really need to completely redefine retirement. It is not a chronological age, it's a mathematical state of financial independence. The golden rule of thumb here is the 25x rule. Your goal is to accumulate a liquid corpus equal to 25 times your expected annual retirement expenses. Once you hit that target, strategies like the 4% safe withdrawal rate allow you to safely pull out a small percentage of your money every single year over decades entirely without the fear of outliving your wealth.
But a quick word of caution. Inflation is the silent wealth killer. 10 lakhs today will absolutely not have the same purchasing power in 20 years. So when calculating that 25x number, you must plan for the real cost of future living, which typically means adjusting for a default inflation rate of around 6%. If you ignore inflation, your financial plan is just an illusion.
So this framework brings it all together. These are the 6 pillars of your financial health: savings, emergency fund, insurance, investments, debt, and retirement. Successful wealth building isn't about perfectly timing the stock market. It's about making sound, balanced decisions across all 6 of these pillars consistently and crucially in the exact right order.
This deterministic math-first philosophy is exactly what inspired us to build NitiVitt, because instead of asking what product you should buy, we first ask whether your financial foundation is actually ready. That's the core idea behind the Niti path. Think of it as a single financial brain. It looks at your specific situation and uses pure math to answer one vital question. What is my highest impact next step? AI assists with the explanation, sure, but mathematics always decides the path. It replaces all that financial anxiety and dense jargon with absolute clarity. If this explainer helped you think a little differently about your money, consider exploring your own financial health and discovering your Niti score over at NitiVitt.in. Our overarching goal is to deliver wise wealth for every Indian by democratizing unbiased financial intelligence. So take a step back, look at your own financial house, and ask yourself, are you laying a solid foundation, or are you just out shopping for windows? Because wise wealth isn't about doing everything. It's about doing the right thing at the right time. Thank you so much for joining me in this explainer, and I truly wish you clarity on your financial journey.